You're 34 years old. You earn $85,000 a year. That's more than 60% of Americans. You have a job with benefits. You pay your bills on time. You're not reckless. You don't gamble. You don't do anything obviously stupid with money. And yet, you have maybe $3,000 in savings, no investments, a car payment, a credit card balance that never quite goes to zero, and a low-grade anxiety that never quite goes away either. You're not broke, but you're not free. And here's what no one tells you. That's not an accident. That's the system working exactly as designed. We have a strange cultural relationship with money. We love to blame poor financial outcomes on personal failure, on coffee, on avocado toast, on not working hard enough, or not wanting it badly enough. And look, personal choices matter. They do. But there's a deeper story here, one that most financial advice completely skips over. Because most financial advice is built to make you feel like the problem is you, when a significant part of the problem is the architecture of the system you're operating inside. The average American household earns around $74,000 a year. The median savings rate hovers somewhere around 4 to 5%. Meanwhile, the top 1% of households hold more wealth than the entire bottom 90% combined. That's not a motivation problem. That's a structural problem. So today, we're going to talk about why earning good money is no longer the same as building wealth. What changed, when it changed, and why the math quietly stopped working in your favor, probably without you noticing. Let's go back to 1971. In 1971, the United States officially left the gold standard. The dollar was no longer backed by anything physical. It became what economists call a fiat currency, meaning its value is backed by trust and by the full faith and credit of the US government. Now, most people hear that and shrug. Okay, so what? Here's what. From roughly 1945 to 1971, wages and productivity moved together. When workers got more productive, they got paid more. The economy grew, and that growth was distributed. Not perfectly, not equally, but broadly. After 1971, something quietly broke. Productivity kept growing. Wages did not keep up. The two lines that used to run parallel slowly started to diverge. By 2023, American worker productivity had grown by over 60% since 1979. Real wages, adjusted for inflation, grew by less than 18%. What happened to the rest of that value? It went somewhere. It didn't disappear. It went to capital, to assets, to the people who owned things, rather than the people who worked for things. This is what economists sometimes call the Great Decoupling, and it is the single most important financial event of the last 50 years that nobody puts in a personal finance book. Now layer on inflation. When people think of inflation, they think of grocery prices, gas prices, the dollar menu that no longer has anything for a dollar. But the inflation that actually destroys wealth is quieter, more targeted, and most inflation calculators completely miss it. Since 2000, the price of a college education has risen by over 170% in real terms. Healthcare costs have roughly tripled. In major cities, housing prices have increased by 200 to 400%. Meanwhile, the official CPI, the Consumer Price Index, which is how the government measures inflation, tells you inflation is running at 3 or 4%. Why the discrepancy? Because the CPI measures what the average consumer spends. It's heavily weighted toward things that have gotten cheaper: electronics, clothing, manufactured goods. It underweights the things that are actually destroying financial mobility: housing, education, and healthcare. These aren't luxury items. They're the 3 biggest gates to middle-class stability, and all 3 of them have been quietly, systematically repriced beyond what an income can reach. So here's the trap. You earn more, but the things that matter cost more faster. You feel like you're moving, but you're on a treadmill, and the treadmill has been gradually, imperceptibly speeding up. Here's the uncomfortable math. In 1990, the S&P 500, America's benchmark stock index, sat at around 350 points. By early 2024, it was above 5,000. That's a roughly 14-fold increase in just over 3 decades. If you had $10,000 invested in a basic S&P 500 index fund in 1990 and did nothing, absolutely nothing, you'd have somewhere around $140,000 today. If you had zero invested, you have zero, which sounds obvious, but here's the point. Wealth in the modern economy doesn't primarily come from working. It comes from owning things that appreciate: stocks, real estate, businesses, intellectual property. And the cruel irony is that to own those things, you first need to not need the money. You need surplus. You need breathing room. You need a margin, a gap between what comes in and what goes out that's wide enough to actually invest. For the bottom half of American earners, that gap essentially doesn't exist. One medical bill, one car repair, one missed paycheck closes it completely. The top 10% of Americans own roughly 89% of all stocks. The bottom 50% own about 1%. So when the market goes up, and over long periods the market goes up, that gain goes almost entirely to people who already have wealth. The rich don't get richer because they're smarter. They get richer because they have exposure to the asset that's rising, and most people don't. This is how inequality compounds. Not through drama, not through corruption, just through math running quietly in the background every single day. And then there's the part nobody wants to say out loud. You are a target. There are entire industries, some of the most sophisticated, well-funded, brilliantly engineered industries on Earth, whose entire purpose is to convert your income into their revenue before you can convert it into wealth. In 2023, Americans spent an average of $219 a month on subscription services. That's nearly $2,600 a year on apps, streaming, software, and digital memberships, most of which auto-renew, most of which people forget about. Buy now, pay later services, Klarna, Afterpay, Affirm, processed over $75 billion in transactions in 2023. They are, functionally, a rebranded version of consumer debt, packaged to feel like a feature. The average American carries $6,000 in credit card debt. At an average interest rate of 22%, that's $1,320 a year in interest alone, roughly what many people contribute to retirement savings annually. And here's the thing, none of this feels like a trap when you're in it. It feels like living. It feels like convenience. It's designed to feel that way. The sophistication gap between how these products are sold and how they are understood is extraordinary. You have behavioral psychologists, data scientists, and A/B testing engineers working to optimize the moment you open your wallet. The counterforce is a YouTube video from a guy with a whiteboard telling you to make a budget. Guess which side is winning? Zoom out further, and it gets darker before it gets lighter. The 2008 financial crisis wiped out roughly $13 trillion in household wealth in the United States. Middle-class homeowners bore the brunt of it. Banks got bailouts. The Federal Reserve dropped interest rates to near zero. What happens when rates drop to zero? Cheap money floods the system, and cheap money doesn't go into savings accounts paying nothing. It goes into assets. Stocks rose, real estate rose. The wealth of asset owners recovered, then surpassed their pre-crisis peaks. The median American household net worth took nearly a decade to recover. Then 2020, another crisis, another round of money printing, another asset surge. Between 2020 and 2022, U.S. home prices increased by roughly 40%. The S&P 500 doubled from its 2020 lows. For people who already owned homes and stocks, a windfall. For people who didn't, the cost of entry just doubled. This is the mechanism. Crisis hits. The system responds by inflating assets. People who own assets win. People who don't fall further behind. And then everyone acts baffled at why wealth inequality keeps growing. It's not baffling. It's predictable. It's almost mechanical. So what do you do with all of this? Here's where most videos would give you a 7-step plan and a call to action. Open a Roth IRA, cut your subscriptions, invest in index funds. And those are fine things to do. None of that is wrong. But let's be honest about what it actually is. It's working the system better than the average person. It's optimizing within a structure that is still at its core tilted. The people who get genuinely wealthy, not just comfortable but actually free, are almost all either inheritors of capital or people who found a way to own something that compounds. A business, real estate, equity, something that works while they sleep. Income is a treadmill. Assets are an escalator. The question that should actually keep you up at night isn't how do I spend less? It's do I own anything? And if the answer is no, the next question is harder still. Because in a world where wages have decoupled from productivity, where inflation quietly reprices the middle class out of every major asset class, where entire industries exist to harvest your disposable income before it can become capital, earning more is necessary, but it might not be sufficient. And maybe the most unsettling thing you can sit with today isn't about money at all. It's this. If the rules of the game are designed to keep most people running in place, what does it actually take to step off the treadmill? That's the question nobody in personal finance wants to answer, because the honest answer isn't comfortable, and comfort, ironically, is exactly what they're selling.